Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I'm doing great, Joe. I'm feeling in the Christmas spirit, or the holiday spirit, I'll say. We got our tree last night. That'd be December 15th, a little late to the party, nonetheless. But I tell you what, this morning, I went out, grabbed my coffee, Buddy and I, my co-pilot sidekick, went out and grabbed my morning coffee, came back in the house and was overjoyed with the smell of the holiday season from that tree. So good. Love it, just absolutely love it. And so we let it sit overnight, and this evening, actually I'm taking the afternoon off with my girls, and we're going to go, like to Swanson's nursery and get a wreath and some ornaments and kind of have an afternoon together for the Christmas spirit. So how about you? Last I spoke to you, last time we recorded, which was yesterday, you were going to be jumping up onto, you were up at Crystal. How'd it go? Tell me, I'm jealous.
It was a good first day. There wasn't a ton of new, fresh powder, but there was enough to make it soft. So it was cool. It was fun. Like I said, first day, didn't do anything crazy, and it was soft enough to have fun with it and not skid all over the ice.
Nice.
Yeah.
So that was your guys' first run out this year?
Yep.
Awesome stuff. Are you there today again?
No, we came back down, and we'll go up probably on Thursday night and then ski on Friday.
Awesome. I know the weather. I have to get my holiday act together. So we're skipping this weekend. Otherwise we were going to cut school on Friday and go to Stevens, but it looks like it's going to be a little rainy. So I decided I better just buckle down and get all I don't tell my kids, but I haven't got them anything for Christmas yet. Oh God. Today's the 16th of December. But I am feeling the holiday Christmas spirit. So I hope you guys are all too. And with that said, we have a fantastic gift for you today. That's right. Today, we have with us on the show Nghi, who's the general manager of Certain Lending and one of our favorite people on the planet. Many of you might know Nghi or done business with Nghi at Certain Lending, but Certain Lending secures financing for real estate investors across the country in 42 states. That's right. If you are listening outside the Pacific Northwest, you too can do business with Certain Lending. They lend on everything from multifamily repositionings to infill developments and anything in between. You can certainly at Certain Lending, expect consistency, choice, honesty, and optimal financing from our friends at Certain Lending. So welcome, Nghi. Glad to have you back on the show. And today, everybody, here is the gift we are going to be giving you. We are going to be talking about BRRRR takeout financing strategies, as well as a little hack on how to get 100% financing to maximize your BRRRR investing. Welcome, Nghi. Let's do it.
Thanks, guys. I'm happy to be back.
As always, we could talk to you every day, all day, because you are the man when it comes to these lending strategies. So we appreciate you sharing these details with us today. So Joe, let's kick it off and let people get to know Nghi for a second.
Heck yeah, guys. So if you don't know Nghi, now is the chance to get to know him. So Nghi, tell us how you landed at Certain Lending and give us a brief summary of your background, if you would.
Yeah, it was by chance, to be honest. I mean, where the world of real estate takes us, right? I was working full time for most of my professional career, and then I started investing on the side about 6 years ago. Started out doing fix and flips here in Seattle, and then over the course of the next 3 years, I just borrowed from and talked to a lot of different lenders. I was always just chasing rates and terms essentially, and seeing what other lenders can do. And I got to the point where I realized that there wasn't a great product or a great relationship for me, mainly because these guys just didn't seem to get it. Right? They didn't seem to get and understand what it means to be an investor. And so, came across certain lending, thanks to Leica, actually. She introduced us. And she said, "Hey, you guys are looking for someone who is in the Seattle market, knows the financing stuff, is an investor." And for me, I was just looking for people who want to do something new, and the right kind of people, right? The smart people with the pedigree, and who can actually get it done. And so we saw that we had the same visions and goals, and we kind of just got together and say, "Hey, let's just get out there and change the entire financing industry for investors." So that's basically the short story. I'm here because I couldn't find what I was looking for out there already.
Awesome. Couldn't find it, went and created it, made it available. We appreciate. And Certain Lending is based out of what, San Francisco?
That's where, and that's where our main headquarters is. Although I would probably say Seattle is essentially another headquarters for us.
Awesome. Good stuff. Well, let's jump into it. Let's kick it off and let you run through your slides here, which I have already looked at, and I can't wait for everybody else to see as well. So I'm going to give the mic to you, Nghi, and take us through it.
Awesome. So I'll just dive straight into it. We're talking about BRRRR, right? And so let me describe BRRRR for a little bit. So BRRRR is, well, if you think about the traditional way of buying a rental property, you have to save up cash so that you can put 20-25% down, right? That's how most landlords buy rental properties. And the problem with this is your down payment now gets stuck in the property, and your ability to acquire properties is dependent on you being able to continually come up with down payment, which means that investing the traditional way is very slow. And, for millennials these days, they just want to do everything fast. I want to retire in 5 years. I want to, and so there's a new strategy that came about that's called BRRRR. And technically it's not new. It's just a new age and clever and catchy way of describing it. So what if you didn't need to come up with down payment or keep coming up with new down payment to buy properties? That essentially describes why people do BRRRR, right? It's a fix and hold strategy, and it stands for buy, rent, rehab, refinance, and the last R is repeat. Sometimes that last R is omitted but it just means the same, right? Whether there's 3 R's or 4 R's, when people talk about BRRRR, they're talking about a fix and hold strategy. So if we walk through the steps in more detail, right? The buy means that you're purchasing a undervalued or distressed property, usually with hard money, but could be conventional or cash as well. And then after you close on it, you start rehabbing it, right? That's the second R. And you rehab it because you want to make it, well, 2 things. You want to improve value, and you want to make it rent ready so that you can go to the next step, which is to rent it out. And you can rent it out in many different ways. Most people are thinking of a long-term rental, right? A standard 12-month lease with a tenant. But you could also rent it out with Airbnbs, rent by the room, corporate rentals, kind of any kind of way you want to. I mean, the BRRRR is pretty flexible. The 4th step, or the 3rd R, stands for refinance. And this is what makes the BRRRR strategy so enticing. If you do it correctly, the refinance should get you back all of your capital, which is mainly your down payment that you put into the deal, and maybe even more than that if you got a great deal. And then, of course, the last step, repeat, is basically using that cash that you got back from the refinance as a new down payment for your next deal, right? So you can start seeing why the BRRRR strategy is so attractive, right? I mean, number one, if you think about it, a lot of people are very used to, in the investor world, very used to rehabbing from the flipper world, right? And a BRRRR is not that much different from a flip. You do kind of the same things up until the end when you refinance and then keep the property instead of selling it. So a BRRRR is a great way for flippers to transition to becoming a landlord. You can also see how it preserves and recycles your capital throughout the refinance and repeat steps. And if you use, hard money or private money to buy the property, you can even put in less down payment up front than you would have traditionally with the regular way of buying rentals. People who use the BRRRR method calculate ROI and they care about two things, right? How much money do you have left in the deal after the refinance? And then how much the property is cash flowing at the end of the day. And so you take the annual cash flow divided by the amount of money you have into the deal, and then you have your ROI. Right? And so essentially, if you can get all of your money back at the refinance, you have no money in the deal, and then you get an infinite return if you're cash flowing, right? And that's, yeah.
What for all the investors that you guys are working with, what do you find that they find as an acceptable ROI? Are people looking for at least 20% or 15%, or what kind of ROI do you feel? I mean, it's an independent question. It's different for everybody, but just kind of as a some people might be new and wondering kind of what they should be shooting for when they're underwriting these deals. You get what I'm asking? What do you think is kind of a good goal on ROI?
I think it honestly depends. Mainly because
we want to go for the infinite returns, but
right.
And
that's the biggest thing is like, what is your goal, right? A lot of people do BRRRR just so they can get cash back and move on to the next one. So they might not even care. They might only cash flow $50 a month, and they're okay with that, right? As long as they get all their money back. Other people do BRRRRs to just get better rents and higher cash flow. And in that case, I mean, it is a personal preference. I mean, you're starting to talk about cap rates as well, right? And I would say and personally for me, any kind of double-digit returns you're getting on your cash on cash is in general pretty good.
Right. I
mean, with BRRRR, although you can potentially get higher. I mean, with BRRRR, you should be able to get over 50%.
Right.
On your cash each year.
And like you said, some people will be happy just to have everything covered and have a tenant be paying down their mortgage. Maybe they're in an appreciating market, right? So they're going to get the value of the appreciation and all their mortgage and everything paid for by the tenant.
Right. I mean, we didn't even talk about all the benefits of having a rent and cash flow, all the 4 benefits, right? But you get all of that and more with the BRRRR.
All right, I'll let you keep going.
Yeah. Well, the only last thing I want to mention about the BRRRR is, you're forcing appreciation and equity on the deal, and obviously, anytime you do renovations on a house, you're forcing appreciation. And as you know, most properties have equity regardless. It's just a matter of where it comes from, right? Whether it's through appreciation for forced appreciation or market appreciation, or through your down payment. And the goal of BRRRR is to minimize your down payment. So keep in mind that, we're going to walk through different things, but most of the BRRRR strategy revolves around conventional mortgages. And so most of this talk will be about conventional loans. Cool. So stepping into it again, there are 3 types of conventional refinances. We'll talk about 2 here, and then the third one is a little bit more special. So I'll talk about that next. So rate term and cash out refinances are the most common types of refinances. And all these terms are used for conventional, but they're also used for non-conventional financing as well, like commercial, portfolio, or asset-based loans, right? We all know that rate term means to pay off a loan and cash out means to get cash back, right? The only difference between a conventional loan and other types of loans are LTVs, usually interest rates, and also seasoning periods might also differ sometimes on the cash out. So a rate term refinance is a refinance that just, again, pays off the existing loan that you have on the property. Although if you want to get more technical, you can potentially get some cash out up to 2%. But the main point is that you must have a loan on the property if you want to do a rate term refinance. It also comes with no seasoning. So you don't need to wait to do this refinance, right? You can refinance whenever you want, even a week after you buy the property. And, although you probably want to wait until the property is stabilized or renovated so that the property has reached its full potential value, its ARV. If you need to count the additional income to qualify for the mortgage or to get your DTI lower, then you probably want to wait until after the property is rented as well. BRRRR, the reason why BRRRR is the way it is, the reason why the refinance is after the rehab and the rent is because of this, right? Most people do want to use that income to qualify. But the nice thing about the conventional loan is that if you have a high enough income from your salary or other jobs, or other types of income, you don't need to wait until the property is rented. Right? You still need to wait until it's rehab, because then you'll be able to use the ARV as the appraisal value, but you're not restricted to renting it out, which is nice too, because sometimes lenders don't count all types of rents, right? Like Airbnb, usually a conventional lender won't count that right away. Conventional loans also have different LTVs for different types of properties or unit counts. And so you can usually get a higher loan on a single family house than a small multifamily. And keep in mind, we're talking about investment properties here. So not second homes or primary residences, which will have different LTVs and different rates, usually better, right? I mean, when you're living in the house, you always get better terms because conventional mortgages were primarily meant for homeowners, not investors. So that's the rate term side. Talking about the cash out refinance, a cash out refinance requires seasoning first and foremost, mainly because lenders view cash outs as more risky. And they also want to make sure that some time has passed to justify a new higher value on the property. But the nice thing is that cash outs don't care whether or not there's a loan on the property. It can be free and clear, or it can be the highest leverage, and you can still get cash out if the LTVs are met. Speaking of LTVs, they're about 5% lower on a cash out than a rate term refinance. And the interest rate is also a little bit higher too, often by maybe 1/8 or 1/4 of a percent. That higher cost is again due to the higher perceived risk of doing a cash out. So to summarize between the two, a rate term refinance is generally better in almost all aspects, except for the fact that you don't get cash out. Right? I mean, there's no seasoning, there's higher LTVs, there's lower interest rates. So again, you don't get cash out, but then a lot of that is dependent on how much of a loan you're getting up front. And sometimes you don't need cash out. So we'll talk about that a little bit more later. On the next one, so we're going to talk about delayed finance now. Delayed finance, or sometimes also called delayed purchase, is basically a cash out, but with no seasoning. And so all the things I mentioned before about cash out, the LTVs, interest rates, they're the same, but now you don't need to wait 6 months to get your cash back. But the other restriction is that you can't have any loans on the property. There can't be debt on the property. So if you have a loan on the property, you'll need to wait 6 months to actually get cash out. There's no way around that. But just because you have to buy the property in cash doesn't mean you can't leverage. You just can't put a loan on the subject property. So if you have another property that you can do a cash out refinance on or put a HELOC on, you can use those funds to buy this house in cash. So I've seen most people do it that way. Most people who do delayed financing have a HELOC from another property that they use, and then they buy in cash, they refinance, and then they pay back the HELOC, and then it rinse and repeat. Right? It's a nice way to get started in real estate, to be honest, because a lot of people have equity here in their primary residence. If you own a home in Seattle for a while, and you just kind of use that equity to keep churning out more investment properties.
Hey, Nghi, is there any restrictions on what you can use that cash for? Like, once you do the cash, let's say you use a HELOC, is there any type of restrictions on what you can use that cash for? Will they make you, I don't know.
They won't necessarily make you do anything with it, but most times when you are getting a cash out, an underwriter will want to know what the cash out is for. Right? And you just kind of need to talk to your loan officer in terms of what's a acceptable answer.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community, And the best part is that it's 100% free. That's right, it's free to join. So, whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
There is one more restriction about delayed financing, though. You can't cash out more than your cost in the deal, right? So the lender will ask to see the HUD or the closing statement from when you purchased the property, which typically will show your purchase price. And that's what a delayed finance loan will cap you at, generally. So most people believe that you can only finance your purchase price, right? However, technically, you can finance anything you put on the HUD. And so if you're able to put your rehab on the HUD, then you can also cash out your rehab costs too. That's a little nice hack. One thing to keep in mind, though, so putting your rehab on the HUD generally means that it will be paid out right after closing. And I think we all can agree that we don't recommend giving your contractor 100% payment up front unless you really, really trust them, right? So one nice trick to get around this is that maybe you can have your property manager accept the funds and then have them pay out the contractor in draws instead of paying out directly to the contractor. And the last thing I want to mention about delayed financing is another risk, right? So buying a property in cash means that you're not going through a lender. And a lot of investors like this because not a lot of people don't like having to qualify for a loan or the entire loan process. And you can generally close faster too. But keep in mind that, to me, I treat my lenders as another partner or another set of eyes. And so not having a lender means you're not having someone else vet the deal for you, right? And it probably means you're probably not getting an appraisal, which gives you an indication of the ARV. And so you better know your numbers and your comps pretty well.
Or maybe you're, buying it with the end in mind, and you're involving your takeout delayed financing lender from the start, right? And you have that relationship, and you say, "This is my plan," and maybe they have some input at that time, right?
Yeah, it's harder because what we're always looking for in the BRRRR, what we care about is the ARV, right? And we assume the ARV will be the appraised value after the project's done, and most conventional lenders don't order ARV valuations. They order just as-is appraisals. So technically you can, there are times when you can just do, like, let's say you go to a conventional lender saying, "Hey, I want to do an appraisal on this," and you even get it done before you close on the property. The problem is that at that time, it's only the as-is or the value of when you purchase the property. So it doesn't necessarily give you an indication, but you can always also approach another lender who knows how to order an ARV appraisal and ask them to do that.
I don't even know that I was meaning that they need to get an appraisal. I'm just saying, like, have your lender partner, show them the deal and the numbers, and necessarily make sure maybe you have a second set of eyes on it, like you're saying, the risk of, having to pay cash, right? If I was calling you, I'd run the whole deal by you and say, "Hey, do you think we can do this as my end result," right? Not order an appraisal necessarily, but just run the deal by you.
That's actually a good point. And actually, I had mentioned that when you want to do the BRRRR strategy correctly, you start with the end in mind,
Exactly.
as you mentioned before, Julie. And you don't want to start all of this until you know you can actually get a refinance loan. It would suck if you happen to buy a property especially with hard money, and then come to refinance, your lender says, "You don't qualify for a conventional loan," and now you're stuck, right? So just, obviously, I say always talk to whoever you're going to do your takeout financing. Talk to them about your strategy first. Talk to them about the numbers, and make sure that you can get that final loan before you get the first loan, or before you even buy the property.
Exactly.
Cool. So that little hack that you mentioned in the beginning, I'm going to talk about it now, and it's not something most people know or do when it comes to doing the BRRRR. And to me, it makes sense. It's always been my goal when I do a BRRRR. So we talked about the 3 types of financing, right? Or refinances. And I mean, I can tell you all the downsides of all of them. So a rate and term refinancing sucks because you can't get cash out, right? Cash out financing sucks because you have to wait 6 months, you have lower LTVs, and you have a higher loan cost. Even delayed financing sucks because you have to find some way to do the entire deal in cash, or you have to have another property with equity. And so what if you can kind of get the best of all worlds without having to deal with these downsides? If you go back to think about why BRRRR is so attractive, it's because you can pull out all your money after the project's done, right? But what if you didn't need to put much money in the first place? Then you would have no need to cash out, right? And this is what I call the 100% financing or rate term hack. There's a few ways to implement it. And I've personally done all of this as an investor. So, which is nice because you want to hear from someone who's done it, right? The first way is to get gap financing, which means that you're buying a property, you already have a first lender. Maybe it's a hard money person that's financing, 80% of your costs or whatnot. And then you find someone else who can give you your down payment, and they'll go in a second lien position. And now you're in the deal with basically no money because you have your primary loan and you have your down payment loan all ready to go, right? Keep in mind, I've also done this with third liens too. It doesn't have to be seconds. And, you might use a third lien if the down payment was too big for a single private money lender to finance, which you'll find a lot of times in the Seattle area, even down payment can still be over $100,000, right? So the biggest thing you need to know when you're doing this kind of gap financing is that you have to do it all at the same time. So you can't record that second lien a day after closing. If you record it after the purchase closing, then it wouldn't count as a rate and term refinance, at least not in the conventional world. The rate term will pay off all mortgage liens recorded at the purchase closing. And so if you record the second lien after closing, then you would need to do a cash out refinance, which means waiting 6 months, right? The other way to do this kind of financing, 100% financing hack, is to actually get your main and one lender to finance 100% of all your costs, which is mainly your purchase price and your rehab costs. A lot of people prefer this because then you don't need to have more people involved, right? Anytime you have more lenders or any kind of third party involved in a transaction, it tends to get more complicated. If they don't perform, if all of them don't perform, then you're not closing, right? If something happens to a private lender, or they go on vacation, or I've even had times where I need to pay off a loan for the refinance, and the private lender is just not reachable. They're in Europe somewhere, and that holds up the transaction. So there's a lot of times you only want to deal with one lender. And the thing is that if you come to your lender, asking for 100% financing, whether it be, private lender, hard money lender, anyone, you're usually going to get no, right? For the most part, most lenders don't do 100% financing. You can find it. I've found a few in Texas where some hard money lenders do 100% financing, but keep in mind that they're generally very, very expensive, and there's still other restrictions. So they might say, I can finance 100% of purchase and rehab up to 65% of the ARV, which means you need to find a really good deal for that to work, right? But it's out there. The second way to achieve 100% financing is to cross-collateralize. What that means is you have another property that has either that you own free and clear or has a decent amount of equity. And the lender will essentially take a lien on that property and the subject property to give you 100% financing, because overall their LTVs are still low across both properties, right? And it makes them feel comfortable. And so that's what a few investors have done. Sometimes they just have one free and clear property that they reuse for this purpose to continually give them that down payment financing. And the third way that I've seen it done is called a down payment reserve or a down payment deposit. We here at Certain Lending, we call it a cash pledge or cash collateral. And what it means is it's not much different than a normal loan. You're still putting a down payment in, which makes lenders feel safe. The only difference is that they write the loan for 100% of all your costs. And so I actually recommend this route more than the other ones, mainly because it's you don't need to rely on anybody else, right? No private lenders. You don't need to own another property, and it's still a standard loan. It's a loan, again, that you put in down payment. It's just a matter of how that down payment is kept and how the note is written.
That's confusing, right? So we're talking about 100% loan, but talking about a down payment.
Right. And I say it's 100% loan to the end lender. So on a refinance, that note that they're refinancing is going to look like 100% loan.
Got it.
And so they'll so that you can still get a rate term refinance on that, and then by that point you'll get all your money back. So it's not as nice as getting 100% financing, but I think you'll find the terms and the availability of that last option much more available than the other ones. Again, true 100% financing gets pretty expensive unless you have private money, which is kind of all over the board, right? I mean, I've seen gap funders, from 12 to 6%, some up to 20, 25%, and several points.
So what you're saying, me, on this last one is that for the refinance, they're counting your down payment reserve deposit, or your cash pledge, as you're calling it, as part of almost like a loan cost.
Well, it doesn't, to be honest, the end lender doesn't even see it. All they've seen is on the HUD is that you got a loan for 100% of all your costs. So the purchase price is maybe $100,000. You got a loan for $150,000, and that's what they're paying off.
Got it.
So it's like, technically you did put in a down payment, but technically it's also 100% financing, and it meets the rules of what conventional loan would require to do a rate and term refinance.
That works for people that have the money. If you don't have any cash, you're going to go with maybe B is a good solution.
Right.
Keeping in mind, everybody, that, I just want to say it's always nice to partner up with people so you don't lose your primary residence because you screw something up, by cross collateralizing or taking a HELOC out or something like that. I don't know. I hate to see people get so excited sometimes that they put their primary in jeopardy, but to each their own, right? Definitely have a lot of equity in your house. You don't actually have to use all of it, right? You're using just some of it.
Yeah, and I also don't recommend people leveraging their primaries either. And if you talk to a hard money lender, 99% of them won't touch a primary.
Right.
Well, cool. So these are just kind of like all the conventional hacks of doing the BRRRR. What I wanted to talk about next is just a way to know how to deal with all of that, right? I mean, if conventional loans are made for owner-occupied properties, to be honest. I mean, the government doesn't really support investors, as you can see. But we're having to do all these things where we play around the rules because of that, right? And not only that, but a lot of loan officers don't know these rules either, because the vast majority of their business is for homeowners. And to be honest, doing a loan for a homeowner is so much easier than doing a loan for an investor. So they prefer it that way too. And oftentimes when a loan officer doesn't know the rules or doesn't want to do the loan, they just tell you they can't do it, or their price is so high that it's just unattractive. And so another way to get around all the conventional financing rules is to just not get a conventional loan. And like I said, there's There's commercial and portfolio loans out there. There's asset-based loans. We'll talk a little more about the asset-based lending side here, just because it's easier to generalize and it's available nationally. A lot of the portfolio and commercial stuff is very localized, and there's just so many different lenders there, and they all make up their own rules that it's just hard to generalize, right? So obviously, this is a product that we have, a certain lending, and we created it mainly just to get around all the rules of conventional. And so I can go through each step. I mean, the first thing is that people always talk about rates, right? Everyone wants to know what your rate is. And usually in the world of most things, more convenience means a higher rate. In this sense, the cheapest loan you're ever going to get on a 30-year loan is conventional because it's backed by the government, right? Out there in the regular capital markets, no one's buying loans investment loans at like a 2% or 2 or 3% rate, right? And so, conventional, I would say on a 30-year loan, investment property generally ranges between 3.5% and 5.5%, depending on how much, points you want to pay or what lender you go through or what kind of scenario you have. I mean, pricing varies differently with different LTVs, with different credit scores. All that matters. For us, our interest rates start at 4.5%, which is pretty low, I would say, for an asset-based loan. And it can go as high as maybe even 7%, but I usually see it in the max in the high sixes. On average, it's in the mid fives. And so, and our rates depend on credit and LTV. The points also vary as well, and that kind of aligns with rates. I mean, on both sides, you usually, even on the conventional side, right, you pay more points to get lower rates, and that's the same for us as well. What's nice is that we try to roll everything up front so you don't have any hidden costs. So, most lenders are basically saying, hey, here's your lender fee, maybe $1,000, $1,500, and then we'll just charge you the cost of appraisal, which you don't really know until you actually get into underwriting and they order the appraisal, right? For us, we're going to say it's $1,500 and that includes your appraisal. There's no other fees. If the appraisal comes out, lower, the cost of appraisal comes out a little bit lower, higher, we'll generally eat that cost unless it goes beyond $1,500. On the prepayment penalties, and this is important, conventional loans don't generally have a prepayment penalty. But what I would caution you is that if you want to have a good relationship with your loan officer, don't pay off the loan before 6 months, because most loan officers will get penalized if you do. So a lot of them don't tell you that because it's, I guess, against the lending laws, and it's kind of steering you away from a loan. But if you value a relationship with a loan officer, don't pay off the loan earlier than 6 months. On our end, our loans will have a prepayment penalty, and it's a standard 3 years, and it's a step down, which means that it's 3% the first year, 2% the second year, 1% the third year, and we can adjust it accordingly. But you pay more or less from that adjustment. And the reason, I can tell you, if you're planning to buy a rental and you're not holding it for long term, there's no point in doing a 30-year rental loan, right? I would just tell you to get a bridge loan or something.
Is your prepayment 3 years step down or 5 years? Because the slide says 5, but you said 3.
So we range between no prepayment and a 5-year prepayment, but our standard is that our base pricing is based on a 3-year prepayment, right? And so if you choose no prepayment or lower prepayment, like a 1 or 2 years, it's going to cost you more in points, which generally doesn't make sense, because if you're going down to that much, it's just get a bridge loan. You don't have any restrictions and it's easier, right? If you move up to a 5-year prepayment penalty, you can usually get a lower rate. Cool. And then the next one is LTVs. So everyone always cares about LTVs because they care about how much, this is how they structure their BRRRRs, right? We know what the LTV rules are on a conventional loan. It depends on whether you're doing a rate term or cash out, right? And it ranges somewhere between 70 and 80%. 80% you can only get on an SFR or a single family house. For us, we play the LTV rules differently. So if it's a purchase or delayed purchase, we'll go up to 80%. And I'll talk a little bit more about that at the end of this. But if it's a refinance, we'll go up to 75%, depending on whether it's a cash out, rate term, and what your credit score is. And so we do allow cash outs up to 75%. And we don't restrict this based on property type. So the same rules apply for all 1 to 4 units. The next thing is seasoning, right? We talked about having to wait 6 months to cash out on a conventional loan. For us, we don't care. I mean, our loans are made for investors. We know that you're doing forced appreciation, so we have no seasoning for cash out. As long as you have at least and stabilized, we're ready to go on the refinance, and that's a big deal. We also talk about delayed purchase financing, and we talked about how you're limited to what you put on the HUD on the conventional side. For us, we don't have that limit. We simply just go up to 80% of value. And so I have an instance right now where there's a borrower that he went to us and saying, "Hey, I found a deal. I mean, I'm able to buy this house for $200,000 and it's worth $350. And so can I get a rental loan to buy because it's basically stabilized?" And then and we told him, "You're leaving a lot of money on the table. I mean, if I did this at a purchase, I would finance 80% of that $200,000. But if you found some way to get cash to buy that property, 2 weeks later, I can do a delayed purchase and finance 80% of $350, which actually puts $80,000 in your pocket from buying this deal." And he didn't have that cash, but he did have a free and clear property. So what we did was we actually gave him a bridge loan that and he needed to close fast, so we got to him in like a week. He used that money to buy this property in cash, and then we did a refinance on a rental loan to pay back the bridge loan. So it's a nice hack, nice trick, but again, it's like this is why you talk to lenders who get it for investment properties, again, kind of advise you that way, right? The next part is a pretty big deal too. So as you know, I mean, conventional loans are not really made for investors. And so unless you have a strong, stable income like a W-2, it is hard to qualify for conventional. Not only is it hard to qualify, but conventional lenders right now, because things are just so busy, they don't even want to take loans that is not, they call vanilla, right? It's simple, easy loans or W-2 loans, and they don't even want to do loans that aren't W-2 because it takes them more time and it makes them the same amount of money. So by dollars per hour, they're making less money. And so, as I mentioned, most investors can't qualify for conventional financing because they either don't have a W-2 or they like to save on taxes by not showing a lot of income. And as you know, that conventional loan cares about income. And the thing is, even if you do qualify for a conventional loan, it's still a headache for investors. I mean, the more properties that you own, the longer and the more paperwork you're going to have to show for each property. So it's not fun. And for us, we don't care about any of that. I mean, an asset-based lender only cares about the subject property. So you can be unemployed and still get a loan as long as the property cash flows. And, conventional loans is based on debt to income, whereas we're based on DSCR, stands for debt service coverage ratio. And that just means that as long as your monthly rents cover your costs, at least for us, I mean, it's at least 20% over, we'll do the loan, and we'll do the loan at that loan amount that you want. There's other nuances, right? Like I can do an interest-only loan to get your cost down, right? So that I don't have to include principal payments as part of your cost to get you a higher loan amount if you need it. So, but they're all 30-year loans. I mean, the interest-only part is maybe interest-only for 10 years, and then after that becomes amortized. So that's a nice little trick that we do sometimes when, again, if an investor comes to us and says, "Hey, I want the maximum loan I can get, and I don't really care what the interest rate is," because interest-only loans are a little bit more expensive, maybe like 0.5% at most. To them, it's still worth it because they couldn't get a loan otherwise, and it gets them out of hard money, right? So, big deal. The other one is lending to individuals, and the limit on number of loans. Like you can't scale with a conventional loan because you don't want everything in your own name. You don't get asset protection by doing that, right? And conventional loans limit you to 10 properties per person. And so there comes a time where if you want to own 30 properties, 50 properties, you're going to have to grow past conventional. And for us is that we actually prefer lending to entities, right? And we have no limit on the number of loans you can get.
Let me ask you a question right there, Nghi. So let's say somebody has a partnership and they're 50-50 partners in their entity. One person's credit sucks and the other's is good. How's that work? How does that affect the loan?
It very much depends on the lender. Most lenders will take the lower credit score of all the guarantors, and including us. So the trick there is to make sure that the person who has bad credit isn't a guarantor. And this depends per lender. Some lenders will like in the commercial world, anyone over 20% ownership has to qualify and guarantee, right? For us is that as long as we get majority ownership, and so if you make your credit partner 51% and you yourself with a bad credit is 49%, you're golden. You're good to go.
Very, very important. I don't think anybody ever thinks about that sort of stuff. Rarely. Like I don't ever hear it talked about as far as how your partner can affect your ability to get a loan. People, for some reason, I never hear it talked about ahead of time. So that's what I'm here to remind all you guys to think about that sort of stuff, right?
Yeah, and that's important. I mean, we had a loan where we've been talking to this one guy the whole time, and then when we actually get into underwriting, we found he only owns like 20% of the entity, and there's this other guy out there who owns 80%, and the other guy's not accessible or reachable. He's actually in Europe somewhere with no access to a U.S. embassy. And so we ended up not being able to do the loan because of that. So it's very important to call out.
Right on.
Getting to the end of it, I mean, so closing timeframes, this is important, especially right now. I mean, as you know, during the COVID, there's been a huge mortgage boom. I mean, you know, like mortgage lenders are sometimes doing 6 months of volume in 1 month, right? And so they're busy. And because they're busy, that closing time frame has gone way up. And as you know, investor loans are generally deprioritized compared to primary residences. So I'm actually myself in a conventional loan right now. I'm on my 6th month of trying to get this cash out refinance done. It's and it's a pain because as an investor, it totally blocks you when you're trying to get a loan, right? You can't put new things on your credit. You have to keep your bank accounts clean, which means you can't spend money buying another property potentially. And of course, you can't do any other purchase or refinance conventional loans until this one's done. So it definitely blocks me. And then every month I have to submit new bank statements, new pay stubs, new documents, and it just gets more and more frustrating. That's probably an extreme case, but it's not too extreme, to be honest. I mean, right now, in general, conventional loans are taking 2 to 3 months to do a refinance on an investment property. It could take longer. I mean, I've heard 4 months is not out of the picture. Most of the major banks are taking 4 months, right? Wells Fargo, Chase. On our side, again, because we have very streamlined underwriting and we don't need to qualify anything but the subject property, we take a 2-3 week closing time frame. And most of that is because of the appraisal. If you are able, if you're coming to us with an appraisal already done by another lender, we can just take that appraisal and close in 1 week.
Is that normal? That most lenders wouldn't accept the appraisal from the other, would they? Or I don't know what the rule is there.
It depends on the lender. Some conventional lenders would and wouldn't, but closing in 1 week on a 30-year loan is generally very, very tough. Okay, so the next part is, again, minimum loan amounts. This doesn't matter too much if you're in Seattle because everything's so expensive here, right? But if you're buying cash flowing properties in other states, which is pretty common these days, even for someone in Seattle, then you care about this. Most lenders don't like to do small loans, and it's mainly because it takes someone the same amount of time to do a $50,000 loan as a $500,000 loan to underwrite, and they don't make much more money off of it. And so they have to charge some kind of minimum cost if they were to do it, and generally that cost ends up being so excessive. Like if a lender says, I want to make $3,000 per loan, right? Then on a $100,000 loan, that's 3 points. On a $50,000 loan, that's 6 points. And it just looks bad, right? And so a lot of lenders either don't want to do it because it's just not making a lot of profit or because of looking bad. Even on the conventional side, I mean, again, it takes so much effort to do these conventional loans for investors. Most conventional lenders don't want to touch loans that are small because their dollars per hour goes down even further from that. And so, I mean, the minimum loan amount varies per lender, right? But generally $100,000 is a good bar, which means that if you're trying to get $100,000 on a 75% LTV, that means that the property has to be worth at least $133,000 to do that. Go ahead, Julie.
I'm just saying, it's all this such great information Such fantastic information. We appreciate this very much. That's why we love you guys at Certain Lending. Love, love, love.
Well, I want to wrap this up. So I know we're all pretty busy. The last thing I'll mention is just credit scores. I can tell you that credit score requirements have gone up since COVID, right? I mean, that's just the way it is. And it hasn't, everything has almost recovered except for that. And so even for us, even for conventional loans, I mean, if you're getting a loan in the low 600s, it is hard to get that loan. And not only that, but it's probably hard to get the LTVs that you want at that loan amount or the interest rate that you want. For us, our minimum credit score is 680. But I know that with conventional, if you find the right lender, and that's always the trick with conventional loans, you have to find the right lender. I mean, they're all playing by the same rules. It's just whether or not the lender wants to do it, right? That can accept a low 600 credit score. And then the last piece is that you have to find a lender who's licensed in the state that you want to do a loan in, which is common across any kind of lender. But for us, is that a lot of people who are buying out of state don't have a good resource or a good connection to find that. Generally, it takes a long time to find an investor-minded lender, and to do it out of state is even harder, right? At the lower price points. And then for us, is that we've already gotten licensed in about 40, 45 states already, and so we're good to go.
What is the reason why you guys have to loan to entities instead of individuals, just so everybody understands?
So our loans are meant for business purpose. And in general, you don't have, every lender is afraid of, mortgage fraud. And the most common mortgage fraud is declaring something as a primary or not declaring something as a primary when it is or isn't. And so for us is people, to ensure that we do business purpose loans, we want to see it in an entity. And also because, again, we want to make sure you're protected from an asset protection standpoint too. And so there's also, rules that come at play when you lend to an individual. Sometimes you're more subject to consumer laws, which a lot of these, commercial lenders don't want to play in.
Right. So does it make sense to compare any of this against an opportunity to get seller financing on a property? If that makes any sense, what I'm asking, it may or may not. I'm just popped into my head, so have that problem of saying whatever pops into my head. So,
well, seller financing to me is just a private money loan, right? And it goes back to the world of, if you have a loan on it, do you want to do a cash out or you want to do a rate term? If you can structure it to give you a rate term, that's better. And you just have to play by the rate term rules of whoever's doing your takeout financing, whether it's us or a conventional lender or some other lender.
Right. All good stuff.
That's it, Julie. That's all I have for today.
Well, that was a lot. My God. Well, as you guys clearly can see, Nghi knows what he's talking about. And therefore, I think you guys are all going, right now. Those of you that this is new information to, or a reminder. And so, of course, we appreciate that. You guys can reach Nghi here. You see people who are listening and not watching here. Nghi, why don't you say your contact details and then let us know how they can plug in with you? Because, for example, where you have your office hours type of stuff and meetups like that, give us a little bit of detail there for people to continue the goodness and the joy of talking to you. Yeah, so you can reach out to us, to me and my team at your phone number. It's 206-237-0105. Or you can email us at teamnghi, so TEAMNGHI at certainlending.com. And the office hours that you mentioned, Julie, we're doing them every Friday. I think this Friday, we're recording this on December 16th, is the last Friday we're doing it for the year because we have holidays for the next couple of weeks. And then we'll probably resume maybe at a bi-weekly cadence after the new year. But we'll post the details on the Seattle Investors Club Facebook group. Excellent. So if you guys are not yet on our Facebook page for Seattle Investors Club, as you just heard, he's going to post the office hours where you can come and ask all your questions and follow up on all this stuff starting early 2021. because you're hearing this here probably at the end of December. So you just have to wait a week or two here to get with Nghi, or of course, contact him yourself on all your deals in the meantime. Good stuff. And Nghi, this is a great transition at this point. Thank you for all this fabulous information and making it super clear and easier for people to understand their choices. And we are, I will remind everybody, and Nghi, I think we can twist your arm to do this. We are offering up a new thing here in 2021 with Seattle Investors Club. It doesn't matter where you are. You don't have to be in Seattle or the Pacific Northwest. You could be in Florida, California, wherever you are. We want to hear from you. We love all the tips and strategies and DIY things that people want to share with us. So we are offering here in 2021 for people to send us videos, 2 to 4 minutes or longer if it's worthy. You can send that to Julie, Julie, at Seattle Investors Club. That's with an S, SeattleInvestorsClub.com. And what we'll do is we are opening our YouTube page. We will post your video with your teaching moment, your aha moment, your DIY hack, whether you're an investor, a broker, a lender, private money, hard money, property manager, all that stuff. We're not looking for like, hey, I closed on this great property. What a great win I had. You're welcome to share with us that on our weekly meetups that we have, but we're not going to do that on our YouTube page. But you guys hear what I'm looking for. And so, Nghi, are we going to be able to count on you to post some cool videos for us and share? We'll call it in our Lenders Corner on our YouTube page. You open for that?
Yeah, and I also have like a lender or financing YouTube page as well.
Awesome.
So
what's it called?
It's called The Lonely Real Estate Life.
The Lonely Real Estate Life. Well, all right. We're going to check that out. You should post that on our Seattle Investors Club page too, because I didn't even know that. So we're going to be opening that up to people. We encourage you all to send me those videos that we're going to vet them, obviously, make sure they're all good to go. And we look forward to having some fun with you guys. Funny stuff too. Come on, let's not be so serious, right? Let's get some funny stuff going as well. You find funny, what's that? The lighter side of real estate. There's all those funny things that you can see on there. We want that in video form from you. Let us know, share with us. Also, just a reminder, every single Thursday from 11:30 to 12:30 Pacific time, you can join the conversation with us. Come get your questions answered, any problems on any properties or situations you have, whether that's brokers or investing or anything, basically anything. Join us on Thursdays. Sometimes there's deals somebody brings a deal and they give it out there. We partner up people. We make network connections. It's fantastic. Massive nuggets, resources drop there every week. And you can access that by just jumping on the Seattle Investors Club meetup.com page. So go to meetup.com, look for Seattle Investors Club every Thursday morning, and just grab the link, the Zoom link for the access. And we'll look forward to seeing you guys there. And that's all I got, really. Joe, where can everybody find the details of today's podcast?
Yeah, we got a good one today, guys, and there's tons of information here in the show notes, and you can find those at seattleinvestorsclub.com/135. That's seattleinvestorsclub.com/135. And if you're watching this, please hit that thumbs up button and subscribe to us. And if you're listening to this, we'd love to have a review, whether that's on iTunes or wherever you're listening.
Good stuff. And as a reminder, you can easily see, I think it's very user-friendly, our YouTube page, where you can see all the past recordings we have, all the mastermind, the weekly recordings that we've done since COVID hit. We've posted and recorded all those on our YouTube page. If you want to go back I like to listen to stuff while I'm driving around. Go back and listen to some of those weekly mastermind recordings, as well as just easy access to see all the hundreds of podcast topics and tips and stuff that we've dropped over the last few years on our YouTube page for Seattle Investors Club. One small note for you guys also is that starting here in January, we are no longer going to be posting the weekly mastermind, or what I'll call roundtable meetups, on our YouTube page. Those are going to be in our membership site for Seattle Investors Club. So going forward, if you're going to want to have access to those recordings, which we are dropping major nuggets every week on Thursdays, we hope that you will go ahead and join us at Seattle Investors Club by joining our membership, which is just $220 a year for some of the best information and education that you're going to get. $220, guys. That's not a lot. So hopefully you feel the value there, and you'll join us at Seattle Investors Club. This is for everybody. It's called Seattle Investors Club, but honestly, that's just because how we started out. But this is an evergreen topics we talk about. Doesn't matter what state you're in, what city you're in. All this applies to you as well. So thanks for listening. Happy holidays, everybody. If you're, I don't even know, is this going to drop before the first, Joe? I think we should.
Maybe before the first. We'll see.
We'll try and squeeze it in.
Probably.
Little special drop. Maybe we'll drop more than one show in a week because we love our friends here at Certain Lending. So we also love all you guys and appreciate your support. And that's all we got for today. So over and out, and we'll see you in 2021.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.